Welcome to the session on prospects of transition bonds. I am Namita Vikas, founder and managing partner of Auctus ESG and senior advisor with CDI. Well, over the next 1 hour, we will deep dive into how transition finance plays out and understand the market view from the providers and the seekers of this solution. But before I start, I must say that the second day of the conference for the day today has been very exciting. And the launch of the climate change investment framework by AIIB and Amundi indeed gave a holistic approach to build climate risk resilient investment portfolios. $500 million of bonds are already deployed based on the EU taxonomy and the CBI taxonomy, where in it will not just look at bonds, but also look at investing in companies that are doing well on transitions. So it's the sustainability way to go. I think the two big takeaways were from the president and the chairman of the board of the Asian the Asian Infrastructure Investment Bank, where he said that he will not finance any coal-fired power plants, a very strong approach. And he also mentioned that AIIB will not finance any projects that are functionally related to coal. For example, roads leading to the plant or transmission lines serving coal power. The CEO of Amundi emphasized on the need for good articulation between what is the role of the government, corporations, and investors, which is the key question and not really the commitment in question. He added that finance can accompany the energy transition, but it cannot define, for example, is nuclear energy green or not? That is the government's role. Sometimes there is a confusion, but we need to define the principles. This was followed by a very interesting session where examples from ASEAN capital market regulators and central banks in fostering development of sustainable finance in local markets were discussed. The discussions were on key drivers, taking actions and steps that can be taken to move into the that led to the announcements that were made on the Sustainable Finance Institute Asia and its role in supporting ASEAN capital markets to achieve this goal. The third session particularly needs a mention here as Lord Turner, the chair of the Energy Transitions Commission, laid out what transitions look like in every sector, steel for example, and how shifts in the energy sector are fast emerging based on the drivers like the balance sheet growth rather than the policy that drives these, especially in countries like India. And it is noteworthy to mention that the session on transition imperatives particularly looked at how to accelerate coal departure, get some capital to keep it going, and at the same time, finance its transition. Repsol announced a change in strategy based on the viability of these investments and to move away. So overall, it was a very impactful day, and I must say that this really gave a perspective on how transition is going to look like going forward. So now let's move on to this very urgent and important topic of transition finance, which has been emerging as a focal point of ESG and financial markets. Helping high carbon companies transition towards net zero emissions is a vital part of combating climate change, and banks, investors, and policymakers need to rapidly step up. That's what we've seen over the last 2 days, in fact, not just today. And this new funding instrument designed to help brown companies shift to greener businesses is slated to bridge the gap between traditional and sustainable financing as businesses begin this whole journey to net zero. Most of you would know that transition bonds, which are emerging as the climate-driven financial instrument, has a sense of a new asset class which is targeted towards not only the high GHG emissions and the opportunities around that, but also fostering inclusive growth and tackling other biodiversity challenges. And given the broader potential investment base, especially in countries, emerging markets, the transition market may even grow the green bond market uptake and provide financial access to those brown issuers who may have stayed excluded from these existing markets so far. However, for the market to grow exponentially, for credible transition bond issuances, investors would need to distinguish between financing genuine commitments and those that are not. So definitions, standards, transparencies, labels, therefore, assumes importance. The CBI white paper on financing credible transitions is a solid step, I must say, in that direction. And it aims to define the transition as a concept by presenting a starting point for the market to see how credible brown to green transitions as ambitious, inclusive, and aligned to the Paris Agreement. It also puts forward an ambitious framework to use the label in practice and proposes clear demarcated roles for both green and a transition label. In order to now move forward and to help develop the transition bond market, investor confidence, clarity for bankers, and credibility for issuers is at most important. Today's session now, I have with me a very experienced panel of practitioners who have been moving the transition bonds needle forward, thus establishing a strong case for mainstreaming of climate-driven financial instruments for corporates, institutions, and asset managers. I would like to do a quick introduction to each of the panelists. So from AXA Investment Managers, we have Takatsuki, who specializes in public and private sector collaboration to contribute towards overall sustainable development. He sits on many committees that define frameworks and guidelines around products within the green finance sector. We then have Mitch Reznick from Hermes. Mitch is an active proponent of transitions to a low carbon economy and works very deeply on the evolution of green finance. Our other panelist is Agnes Gourc, who focuses on debt structures for various market players within the sustainable finance space at BNP Paribas. And from Refinitiv, we have Barnabas ACS, who is a financial data expert, researcher, and a firm believer in sustainability. So welcome to each one of you. And now my first question is to you, Yo. Yo, do you think the financial markets need a new asset class in a post-COVID world? Why and what has changed that is compelling the way finance is being channelized towards decarbonization?
Thank you, Namita, and thank you very much to Climate Bonds Initiative for having me on this panel today. It's a great question to ask, and I think really what goes to the heart of is, what is sustainable finance for? It's ultimately about solving real-world problems. So when we had the COVID pandemic, we found that one of the ways in which we can raise capital to help tackle the healthcare challenges and make a more resilient economy could be done through the creation of an asset class called COVID bonds. And it's the same again for the challenges that we are facing over many years into the future from today to try and achieve the Paris Agreement goals. So trying to keep global warming to 1.5 degrees from industrial times, it's significantly easier to say than to do. And just between now and 2030, we have to cut global emissions by 50% to achieve it. So when you look at it like that, this is not a challenge that is really a focus for small components of the global economy. There are parts of the world economy that have made great strides over the past 2 decades into essentially creating technologies that belong in what I would call the 1.5 degree world, which is what we're trying to achieve by 2050. But the reality of the situation is that large components of the world economy, these are industries like steel, transport, energy, real estate, etc., who have really been the building blocks of our prosperity in the post-World War II era, have also been those that have led to some of the biggest environmental footprints. And we're starting to really understand the full scope of the challenges in essentially turning around an economic model that we've created that's very resource dependent to one that has essentially a far lower environmental footprint going forward. I think over the past 10 years, practitioners like us, what we've seen is a real awakening of the green finance agenda. And to me, this has been a real success. The green bond market is one aspect of it, but it's really more about the broader green finance market, ranging from equity, bonds to other forms of financing, including bank loans, government credit, etc. So the challenge here is by also recognizing that while we have partially resolved the challenge of trying to meet 1.5 degrees, there are many industries and many markets around the world who haven't really taken that really important first few steps on that journey to significant decarbonization. And this is the key, it's about significant decarbonization. And large investors such as us, AXA, we want to provide the capital to try and help these companies, these governments, these other entities go on that journey. So when we talk about the issue of asset class, this is really about not what are we doing in the world of finance to meet our own ends. It's about how can we best enable the solving of real world problems. And as far as I see it today, when it comes to the challenge of achieving the Paris Agreement goals, the most important thing is that we take the whole of the world economy, every sector, every company with us on the journey to significant decarbonization. Our idea that we've put forward over the years, which obviously we thoroughly back the work of the Climate Bonds Initiative and also their partners in discussing this issue of transition finance, is that we think, a separate asset class may be able to better encourage those types of companies that haven't really significantly come into the green finance market yet, make that step to link their capital raising to its sustainable commitments. And for us, that's really the work that we've been doing in various different forums.
Thank you very much. I think it's a very important point that you've made is as to how do you best enable the real world problems and looking at the large components of the real economy that need to be moved and that need to be addressed. I think it is a very well said point. Thanks, CEO. So if I may move to Mitch, who's the next panelist. So Mitch, as an active proponent of the transition to a low carbon economy, how does transition finance evolution look like to you? And how do we justify banks with exposures to oil and gas sectors issuing green bonds versus the oil and gas companies which are encouraged to take the transition bond route for projects that meet Paris Agreement necessary trajectories? Over to you, Mitch. Mitch, you're muted.
Thank you for doing that. I was trying to be polite by taking myself off of mute. It's okay. You just missed my my thank yous to you and to CBI, and it's a pleasure to be on this panel with this group of people and to be a part of the conference, which has been excellent. Look, Yo has elegantly, as he always does, laid out the crisis that we're in and the urgent need that we have right now to bring all participants in the economy into this decarbonization trend. And the reality is that we're not going to get there from here without the, shall we say, the most egregious emitters following along. So what we need is these heavy industries to decarbonize faster than the economy itself as a path to creating decarbonization as the wider economy. So, and again, as you pointed out, that sort of justifies the need for something called a transition bond. Frankly, there's probably a bit of a marketing component to that. We know that so-called green bonds that have come to the market have failed because they weren't green enough entities. I think Marfrig comes to mind, and of course Repsol, and reinvented themselves as transition bonds. But frankly, as far as I'm concerned, it doesn't matter to me if it's called a rainbow bond or brown bond or transition bond. The key thing is these sectors absolutely have to find financing for these transition pathways. And so it makes absolute sense. Now, where we are now is in many ways not unlike where we were with the green bond market several years ago. So there's a lot of hope, shall we say. And there is a hunt for genuineness, sincerity and genuineness in transition bonds. You could call for standards and norms, which we are encroaching on and consolidated around in the green bond market. These norms are important to create certainty and visibility and predictability for both banks and for issuers to know what they're doing. But there are some challenges too. Look, I mean, the reality is that from a mandate point of view, there are multiple green bond mandates that are out there. So there's profound technical support for green bonds. The recent green bond from Germany at 6 billion was something like 5 or 6 times overdone. You can imagine the order book for that. And we've seen that the green bond order books are multiple times done more than mainstream bonds. How do transition bonds participate in that technical support? There are transition bond funds because there simply aren't enough transition bonds out there. So maybe, mitigating that, as we're working on building portfolios and, around thematic mandates around Paris, low carbon, that provides an opportunity to include these types of bonds. So that's quite helpful, but they're still early days. And to your question about banks, it's a really good question because it does speak to this aspect of marketing. Again, it's like, it's just a label, but who cares? It's a passport to the global markets and to address the climate crisis. And I'm indifferent to that. But banks, lest we forget, I mean, banks have multiple business lines. They are not just in the business of creating economic value that has a externality that has negative effects for greenhouse gases. So you could argue that even though they're financing so-called brown industries, they're in multiple industries, so they're not seen as this simply being brown industries. And also banks are, I mean, I know we've got BNP Paribas on the line. Credit Suisse has been on the panel yesterday. Banks are facing huge amount of pressure and are responding in a big way to shareholders and bondholders that want to see them also join that transition. And, so there's I don't see anything in terms of hypocrisy around that because of that, but also don't forget banks are financing very specific green projects. They can take those funds and allocate them to those kinds of projects that have that long-term effect, whether it's transportation or renewable energy, green mortgages, all these kinds of things that are referred to in the CBI document that was released yesterday. So, and if there's a path to more directly finance those projects, that's great. I think that, the technicals are so strong in the green bond market. If you can find a way in, you're going to do it. And banks have every right to try to get access to that, even though you point to the kind of potential irony and dare I say, the extreme sort of hypocrisy in that, well, you're banking, energy on one hand and you're doing this, what gives the right. But it's also look how they're handling the lending book. Is it, no new financing into certain sectors? Is it winding down? In many ways, it doesn't necessarily make sense to totally choke off capital to these sectors, but it creates a second order effect of jobs and economic value creation. You don't want to lose that. There's the social effects of that are profound as well. So I think I think it can be done because for all these reasons that I've mentioned.
Thanks a lot. I think you've made a very valid point that banks have a larger role to play, and from a decarbonization standpoint, it has to look at a wider economy, and without that, we will go limping on the Paris road. Doesn't matter what kind of label, but finance has to flow through. I think that's a very important point. And what makes me think is, when you said that there are multiple green bonds and transition bonds, I think the tagging could be a very important element to do, because there could be finance that's channelized towards transition bonds, but the tagging is maybe not happening. So I think one needs to use that lens. Great, thanks This was a great input. And moving on to Agnes for the next question is, Agnes, with a focus on debt structures for various market players within the financial sector, do you believe the governance and the structure of the labeled bond market are adequate to accommodate, differentiate, and address the flurry of issuances that can maybe at times mislead investors? So it's also connecting to the earlier conversation that Mitch put forth. Over to you, Agnes.
Good afternoon. Thank you, Namita, and thanks to CBI for organizing this great conference. I feel obliged to answer to Mitch's comments, I guess, to start. And I would say that actually, I feel quite fortunate because in my role at the bank, I'm dealing, specifically with sustainable finance projects. But you're right in saying that banks, as any economic actor today, do face pressure from all stakeholders. And the interesting part I see in my role is that clients, when they discuss transactions with us and think about giving us a mandate, actually that comes really into the equation for them is, beyond what you do in sustainable finance, how do you behave as an entity overall? So as every sector today, we are put under the lens of our stakeholders, including our clients. So when we talk about all these structures and what they could bring to market, really the underlying discussion is partner to partner. What do you do? And so BNP Paribas, we've really tried to integrate sustainability throughout the bank, and that makes our job, my job specifically, much easier, because everybody in the bank has that that knowledge of the topic and is trying to interpret it within their own activity, whether it's labeled sustainable or not. So when we come to the topic of labeled bonds, and Mitch's comment is quite interesting. At the end of the day, it's not just a name. We can name it whatever we want. I think what is really critical is that for market players to really understand what we are talking about, we need to agree on a definition. And that's why we like names. And when we hear green bonds today, what is very interesting, thinking about, the topic of transition. Clearly, transition, we haven't got the full definition yet. I think the white paper released yesterday by CBI is very interesting in that, and it participates to the discussion. You at AXA IM, they had done that already with an earlier paper as well, and we do some work with you and our colleagues at ICMA, EXCOM, and members of the working group on climate transition finance. And all this discussion, they participate into actually agreeing on the definition. When you think on green bonds, now we say green bonds, most participants will know what it means. But if you think a couple of years ago, before the ICMA principles came out, we couldn't agree. Was it climate only, or should we also include biodiversity? Was it climate mitigation only, or could we also talk about climate adaptation? So it's quite interesting to see in a couple of years' time, what was really, really heated debates in the market have become quite mainstream agreements, I would say, and hopefully that's what will happen with transition. But what we see happening today, we are in the middle of it, and if you think of the big debates we had and still have around some topics in the green bond market or in green finance altogether, here we are actually dealing with something that is even more complex, looking at transition. And I think all the graphs that are in the white paper published yesterday are quite interesting. As you can see, it's not a yes/no answer. You have multiple layers in the thinking process. So actually, I think the labels are very useful, I find, so that we can actually have an argumented debate and know what we are talking about. I would say actually there are not that many in my view in the market. If you think about it, a lot of the names you hear, they still fall within the categories of either the green bonds or the social bonds. So for me, when we talk about blue bonds, that's a subsegment of the green bond. If we talk about COVID-19 bonds, that's a subsegment of social bonds. So in reality, what we are looking at today is, transition. Is it a separate instrument? If you look at different levels, if we look at beyond financing of project, we have another label, which is another sustainability-linked bond instrument. And that's really the two we are grappling with at the moment. How do they all fit together? And happy to develop a little bit later about that if you want.
Yeah, I agree that structures and what can be brought to market, very specifically, I think that is very important when, sector, and it needs to also be looked at from a sector standpoint, as, every sector has its own challenges. A complex issue, and yeah, I mean, it needs to be demystified. We have CBI's report very eloquently talking about categories and classification. So that's a good framework to start with, and it's only to see how this market goes forward. So great. I would like to move on to Barney now. Barney, my question to you is that the first quarter after COVID converted from a health crisis to the one of the worst economic crisis, where we've seen a huge impact on the capital markets. How do you see broad and differentiated data help navigate the rapidly changing financial markets and with all the differing views of relevance to transition bonds? So, bring out some of the granularity on the data standards. It'll be very interesting to hear that point of view from you.
Hello, good afternoon. Thank you for the opportunity. Pleasure to be here. And of course, it was a very, very good and insightful 2 days already. Just a couple of points on, differentiated data points and its value. With COVID, the aspects, either temporarily or maybe more permanently, of ESG have changed or shifted a little bit. So, when during the early days of COVID, the social aspects of ESG came into the forefront in the ways of flexible working hours, for example, or strike actions, or any workspace related controversies. And of course, the governance issues were also very important, because of course, in this case, many corporates filed for some help from the government, and that was, or would have been, or was actually a quite strong public scrutiny around, share buybacks and dividend payments, etc., etc. So to find out and to know more about these aspects of ESG, you would have to have differentiated data sets and as granular as possible. The other aspect of this in relationship to financial markets, what we are seeing this year is, of course, the accelerated pace of regulations, especially in the European Union. The EU taxonomy, the NFRD consultation, the SFDR, RTS frameworks, etc., etc. So what the granular data enables people to do is basically check how much compliant they are with these incoming regulations. The more detailed data sets you have, the better it is to map to different either frameworks or to regulatory requirements. And of course, the other very big added value of this is that information of no information has an immense value. So, for example, in regards of climate, does a company have a policy on emissions, but is that accompanied with targets on these kind of emissions? And of course, companies who are putting these reports together have different appetite on reporting on these. So, when you check your coverage and you check your universe and see what's reported on what, you immediately find what to use, and for regulators in what direction to go to make the market a little bit more transparent. And the other concept regarding green bonds versus transition bonds, or what should be called as per relevance in this. There are two interesting studies I want to sort of bring to you. One is the one that we did, which is basically a taking stock of all kind of green sustainable financing, which was happening in the first half of 2020. So basically, we took into consideration the debt capital markets, the loans, the equity capital markets, M&A activities, etc., etc. And if I add up all those kind of involved notionals, they were 300 billion altogether in the first half. If you sort of extrapolate that by doubling it to, with 2 for the whole 2020, we are getting around the 600 billion number. There is another very interesting study, and unfortunately to some extent very sad study, which was released in March 2020 by the Rainforest Action Network, which basically analyzed 35 bank activities in Canada, China, Japan, Europe, and the US on basically traditional oil and sort of dirty, or to Mitch's points, murderous industries like tar sands, Arctic oil, gas, offshore, etc., etc. Those 35 banks in 2019 put in 730 billion US dollars into that sector, into that set of sectors. So way outweighing the green financing hand. You know, and the sad thing is that it's actually an increasing trajectory. So why I mention this is because obviously whatever you can do to channel money away from these kind of murderous groups, or to assist them to transit out of these industries and activities into a more sustainable one, that then basically that's the sort of the tool set for, you know, let the evil die and good endure kind of Sleeping Beauty quotation, you know, which I tell my kids lately. But it definitely shows the relevance of the transition bonds, and of course, as per data providers, we are very excited about the different implications, how we can help in, you know, in collecting all the underlying T's and C's and reporting around it.
Pertinently mentioned how COVID is, you know, has made ESG take a new shape, and how, you know, the overall interpretation and usability of data therefore has increased in a big way to be an enabler to bring about traction. Thanks a lot, Barney. And if I may now move to Yo for my next question to you, Yo, is that AXA was the first to issue guidelines on transition bonds. However, not much progress has been made since then, neither from an uptake overall nor on the regulations front. I think there was a framework out there. So tell us, how critical is it for the regulators to act quickly to formalize the norms around transition bonds, demystifying it, especially since there has been a surge in the green bond market during the pandemic, and therefore the potential of acceleration of issuances of transition bonds. Your views, Yo.
Yeah, so I mean, I guess the first thing to note is that the green bond and transition bond isn't some sort of big battle out there. It's not a Star Wars galactic battle, a bit like your background, Namita. The point is that we need all of these tools to try and achieve where we want to get to. And for the transition financing section, this is a cohort that isn't really coming into the green bond market in any great way. So the corporate space has largely been the utilities, electric utilities, so power generators, some technology companies we've seen, and a few transport companies, which has been very encouraging. But when you really talk about hard to abate sectors where there's a lot of work going on with regards to these 1.5 degree transition pathways, this is not a sector that is jumping into the green bond market, even in this very busy September. So that's really the first point to note. The second point to note is any idea takes a while for it to be established. I mean, for us, when we wrote that document last June, it was a call to action. What we wanted to say was, guys, we need to talk about transition. You know, let's not just focus on green and pretend that that's going to resolve the issue. And let me give you a very sobering study that we did. So we looked at our book of fixed income assets. We run about 500 billion euros, so $500 billion. And we switched out of coal and tar sands. There was a divestment procedure, and put some of that money into the greenest of assets. And so over the course of about 3 years, the best way to put it is we divested out about 10 billion euros and moved into 10 to 15 billion of green. So currently we invest in about 6 billion euros of green bonds. Now that sounds like a lot in absolute numbers, But when you look at the total sum, which is 500 billion, we're literally tinkering around the edges. Now, we've also created a scenario analysis tool, which is essentially like putting a thermometer into our portfolios. And if you take a portfolio that is exposed to all fossil fuel assets, including coal and tar sands, the benchmark indices, essentially, whether it's in equity or fixed income, they're roughly heading to, I don't know, between 3.7 to about 4 degrees in the future. So the business as usual for current today portfolios, according to our scenario analysis tool for climate, it's a significant overshoot of 1.5 degrees. Now, by taking coal and tar sands, we can take out about 0.5 degree. So a significant amount can be taken. And then a gradual rebalancing of the portfolios over time, trying to allocate to lesser carbon intensive industries or lesser carbon emitting companies within the sector, or those who are the best prepared in a transition. So within the sector, who are the better players? We've been able to take it down to about 3 degrees. So we know, however hard we've tried in what's available today, we still consider ourselves to be one of the most thoughtful kind of leaders in the space in climate investment. We are still really headed to roughly somewhere around 3 degrees. Now, that has just given us the thought that the only way we have to tackle this is tackling the middle block. That bit in the middle, which isn't the greenest, which isn't the darkest brown, but the stuff that we live with day to day. If that doesn't reduce in temperature, what chances does it have? So, you know, that idea, I think, has resonated quite strongly with the market. We are co-chairs of the Climate Transition Finance Working Group within the ICMA Green Bond Principles, Green and Social Bond Principles, and that working group has 80 participants. So, you know, that's carbon intensive companies through to investment banks, investors like us, stakeholders, regulators, all of those people from around the world, including Australia, Japan, Canada, emerging markets, who are all coming together to say, you know, as Agnes said, we need to come to common language about how to define transition. And I think that the paper that Climate Bonds Initiative have published around some of the kind of key principles is a very helpful addition in that. And some of the work that I think that that working group has been doing will be, you know, I think, you know, discussed and communicated later in the year. So we hope to provide a bit more space. When it comes to regulators, let's be absolutely clear. Right, and regulators won't be happy for me to say this, but generally on the whole, when it comes to sustainable finance, they've watched first, seen how the market has grown, and once it has become material, they've started to intervene. So the green bond market is 12 years old now. And the green bond standard of the European Union, which really is the only kind of meaningful standard being proposed from a regulatory and compliance perspective. There are other smaller regimes, but this is the one that everyone's taking notice of. It's taken 12 years of the market, right? Transition bonds, we've been doing it for 12 months. It's a baby. And, you know, to date, we've had a handful of things which have labeled themselves transition, some which are, I think, legitimate transition bonds, others which probably are a little bit more questionable and might be more of a kind of marketing angle, as Mitch has said. Now, look, this is just a part of the flow of how a market grows. And, you know, we've seen just within this space, the growth from the use of proceeds bonds to other structures. And I think we will continue to see more novel fixed income structures, equity structures, hybrid structures, you know, other forms of, to try and achieve the same aim, which in this case is, how do corporates go on this very disruptive journey where often the technology doesn't even exist today to significantly decarbonize quicker than they would want to otherwise, but without doing so, essentially they're letting the rest of the side down, right? And that pressure is coming from us as investors, from regulators, governments, stakeholders, and it's becoming louder and louder by the day. I've been engaging oil and gas companies for the best part of 10 years. And, you know, some of these big European majors have announced big corporate strategies around net zero by 2050, which is fantastic. But let me tell you, that took a decade to achieve, right? So if we don't do the hard work today for this, we will lose out on the things we really want in 2030. So, you know, when it comes to transition bonds, we're still in early days. but let's think about where this needs to be in 5 to 10 years' time.
Well, we need leaders like you so that there are, many followers to the positive impact that we want to create. And I must tell you one thing that, as far as regulators are concerned, my experience in India has been that our market regulator was very fast to issue the green bond disclosure norms soon after we just did the first or the second bond. So I hope that they look at transition bonds also equally quickly. So thanks a lot. And moving on to Mitch, I would like to ask you that, the availability of the transition bonds will provide investors with more opportunities to finance corporate efforts to decarbonize. But thus, the differentiation drafted between transition bonds and green bonds inadvertently lead to an increase in greenwashing. So how do you see guidance on the financing credible transitions that CBI has, for that matter, released, helping create a transition label with impact? Mitch, I think you're muted again.
I think I need my teenage daughter to help me work Zoom, even though I've done so many conferences on Zoom. Look, as is a recurring theme, if the green bond market is in its nascency, then what is the transition bond in? It's before its nascency. So, there are already problems with greenwashing in the green bond market as it is now. So, of course, you're going to have maybe some of these issues. Look, it's an attractive market. Just as nature abhors a vacuum, banks and issuers and investors themselves looking for bonds, want to tap into that technical demand that leaves us vulnerable to it. But what is a transition bond? You could argue it's a green bond that has failed in name but succeeds in purpose, and that's why we need them in that respect to draw out these companies that are in this transition period that don't make it to the green bond market because of their core business. I think that reading the CBI paper, it is the flowcharts established some norms that you need that help, but really it's I think as a portfolio manager who tries to build portfolios and looking for names that fit into low carbon or Paris aligned, it certainly helps to have we'll screen for green bonds and what's maybe labeled transition bonds, but where we start the search is attaches itself to the soul of the company. Where are you in terms of where are you in terms of CDP? Are you disclosing? How long have you been disclosing? Or have you signed up for science-based targets? What are the targets like? How credible are you in doing that? And so it's true, a transition bond or a green bond is going to provide some credibility to these bold statements that we hear, but and I think the transition bond market, the green bond market do that. They create a link to sort of, look, in that type of thematic portfolio, we need companies that are credibly decarbonizing. And I also, Yo's point about, look, the top end is one thing and the low end, those scope 3 guys that are never going to change, okay, that's one end of the market. But what about this big middle tranche? Again, we need this vast component of the industrial market to decarbonize again faster than the market. Now, so that, and a lot of them have made these statements, but attaching themselves to this credibility and use of proceeds, reporting, transparency, all these things are really important. I know that the CBI is calling for that. So per your question, I think CBI calling for that and others is really important. But one important component of this is, okay, don't avoid the laggards necessarily, because, invest in them, engage with them, have these companies change, and that will lead to performance. And, I understand the exclusions, understands the values-based portfolios, and that's fine. But I think that there is an important aspect of this, of being involved, being a financial stakeholder, leaning on that financial stakeholding to influence companies. So the labeling, all this stuff is really important. It is necessary, but it's not sufficient, as I think everyone would probably agree. But I think, per your point, I think, you know, CVI and others, again, sort of underscoring how important, you know, you want to do this, attach credibility to it, because each investor is going to have their own threshold, and investors in this thematic market are going to want to see credibility, and that's use of proceeds, transparency, reporting, actual, you know, be brave enough to show the numbers so we can track it. Make yourself vulnerable to that analysis so that we know that you really care about it, and so that we can track the change. But yeah, I mean, there's always going to be a risk of that sort of greenwashing, or even I saw for the first time the document transition washing. I love that one. It's like everything's been named after the Watergate. Everything is a gate now. So it's sort of the same thing.
I liked what you said. Green bonds failed in name and succeeds in purpose. I think that's a very, that can be one of the definitions that can broadly, as a starting point, be looked at. So Agnes, my question to you is more of a follow-up from what Mitch really said. The transition bonds as an asset class is evolving, and therefore, you know, it has so much more potential. It can be a bridge to better practices, help companies and sovereigns raise funds to fund projects that may make them, if not green, at least less brown. The trouble is, while there is demand from investors and issuers, and while the philosophy behind transition bonds as an asset class makes sense, you know, what do you see as some of the challenges and opportunities to move the traction towards transition bonds to emerge faster into the mainstream of corporates, institutions, and asset managers?
Thank you, Namita. So I think, yeah, the question is going faster is a difficult one. I think what I would say is that, and that links back to what Mitch was saying earlier, whatever we do in sustainable finance, it all really anchors into the strategy of companies and banks and whatever clients we work with, if you want. So actually, at the basis, you need companies to really take notice of obviously the new world they are in and to start changing. And a lot of issuers says, yeah, but, you know, kind of, you know, we are starting a transition, but, you know, we are not there yet. And clearly, you know, it's taking time. It's not the kind of changes that, you know, they can be announced overnight. They cannot always be implemented overnight, but clearly a lot of sectors are into that start of change. And if you, in the course of the conference, and again on this panel, we've touched upon the oil and gas sector, where you see some of the recent announcements by the European major, there are actually really, really huge changes into actually the business model of what is not really an oil and gas sector anymore, but is going to become really an energy sector altogether. And so actually we cannot, you know, to go faster into sustainable finance, first and foremost, you need those changes to start happening as well in the real world, to come back to kind of Yo's comment that, you know, we don't do anything in a vacuum. Now, obviously, sustainable finance is there to accelerate this movement. And I always refer to the market we have as a jigsaw, if you want. And at the moment, it's fair to say we don't have all the pieces together. They kind of start getting into shape, but they are not really kind of there yet. And the way we are going, I think, to come to a definition of, you know, what do we use when, is really having a clear purpose for each type of transaction, both, you know, what is the purpose for it serves for the issuer, what is the purpose it serves for the investors. And that's the key discussions today in the market. So in the transition bond market, there's been a number of transactions today. We've been very happy to work on the two SNAM transactions. We worked on Cadent transactions. And as you can see, this is a very specific sector, is gas transportation. So you know, you can look at it and think, okay, maybe we can define it by sector. And that was kind of some of the, even our original thinking. The more we progress, the more it's clear. And in particular, when you look at the announcement of oil and gas, that actually, you know, some sectors are going to evolve very rapidly. So just categorizing one sector altogether and saying, if you're in this sector, you're going to be, you know, going into this type of instrument, is probably too far-fetched and it won't work very well. And another example that I find quite telling, we've worked on the Daimler green bond that came to market last week now. And effectively, a couple of years ago, we probably would have all thought it was quite challenging for a car manufacturer to come to the green bond market and have a plan to really kind of, you know, be able to come to that market frequently. And as you can see, you know, 2020, that's entirely feasible, and probably for many players in that sector today. So in a nutshell, you know, I think the instrument is there to reinforce really the changes that companies are starting. If they are in a sector that is kind of, you know, quite difficult to change today, and they will have capex and investments that will still be limited, I think you can have an argument that some other type of instruments, such as sustainability-linked bond, can have their role to play. For those that have started really a clear transition and have significant capex that are clearly kind of green, and their whole business model is going to get there in the foreseeable future, you can entirely say, okay, you know, green bond is a good angle. And for those in the middle, really, as I said, the important middle, then, you know, where do they stand? Do they need a new instrument? And that's the big question. Aside from, you know, definition, because that's what we've been kind of talking a lot about, what we've seen in the green bond market, we replicated quite successfully for social bonds, and that we need here as well, is we need a whole ecosystem of market participants, really, that can all, you know, build together and really provide their views. So recently, you have noticed some of the second-party opinion provider, for example, publicly released methodology for transition bonds. That all participates to the development of the market. You can think of, you know, the regulator angle. As you were saying, we have, you know, the taxonomy today. Do you have a definition of what is a middle ground coming at some point, that, you know, between what is really green, what is really brown? That's a possibility. Do you have really an accreditation of the second party opinion provider, as you're going to have in the EU for the EU Green Bond Standard, and that helps really reinforce transparency. So I think, you know, it's in process. I think it's really encouraging to see that, you know, there are quite a number of transactions today that are trying to build that path, and all issues that come, you know, early in the markets. And whether you open a new sector in the green bond market, or whether you open a new market altogether, you know, it takes a lot of courage for an issuer to do that, and I think that has to be recognized. And what they say to investors, effectively, you know, we've put our commitments on paper, but here we translate it in the financial world, and we have greater accountability for it, which in turn obviously gives greater power to investors as well to implement it. So that's, you know, that's what we are trying to foster really in this market.
Thanks, Agnes. I think, you know, indeed a huge opportunity for business models to change course and, you know, look at opportunities in this adversity. That's the way forward looks like. So Barney, my question to you is that there does seem to be a view that any kind of technology that might lock in the use of fossil fuels doesn't qualify for green bond financing. And in case of transition bonds, would you elaborate, what are your views on the scenarios that don't include use of fossil fuel and yet are led by technology that will take us to the 2050 targets? So if you could just share your thoughts, please.
Yeah, just to continue on the green bonds and transition bonds. a little bit. I think and this is what I really like in the AXA document, is that it basically states that the green bond is an eligible green project, whereas the transition bond is basically a climate transition related activity, which enables which offers quite a lot of opportunities to actually link the issue closer to the issuer and discuss or introduce the notion of sort of, sustainability default or transition default. And what I mean by that is that, transition, what is transition? I'm in A state, I want to get to B state. So whatever the difference between the A and B, that's a transition. If I agree, or if I can articulate what are the steps, what is the pathway to do so, then I'm talking about a transition activity. And what I very much like about the white paper that CBI introduced is the fifth principle is the action, not the pledge. So if you describe and you have a credible pathway, you actually can create T's and C's around these pathways and basically penalize issuers in case they default on this sustainability or transition angle by, there are so many means, embedded put options, premium, default premiums, or faster amortization, or different covenants that would actually lead to same thing as when that happens. So it would encourage a sort of a compromise between actually acting on what you are saying in your prospectus and when you agree on, and between over promising. And referring back to Sean's initial comments yesterday, this would definitely have an effect on the cost of capital, and as such would encourage companies not to fail on this sustainability angle. And just one sentence on your question, whether fossils or non-fossils, of course we have to be realistic and take into consideration that there are industries that are further away from net zero than others. There are regions that are further away from net zero than others. It's just pragmatism and putting that state of play into a document and identify sanctions in case they are not met. That's my 2 cents on it.
Thank you very much, Barney. I think it's a very important point that, the CBI framework very nicely states the near to net zero to stranded, the entire, what actions will lead to impact. I think that's a very interesting framework that can be looked at. I think we should ask CBI to set up a whole day to discuss transition bonds, and time is just not enough. I'm very watchful that we have 3 minutes to closure, but I think since this is the last day of the last session of the day, we can take a little more liberty. There's nobody ahead of us. So I'm going to go to some questions that I have got from the audiences. And one interesting question, Yo, if I may put out to you, that is here from the audience, which is a huge gap in making the transition at a global scale lacks the volume of investable projects. So how can transition bonds or any other financial vehicle support getting projects to bankable state?
Yeah, so that's a very good question. I have to drop off at the top of the hour. I'm so sorry. So I'm going to do a quick answer, and I'm sure the others can provide a little bit more comment. So I think the first thing to note, and what's becoming apparently clear, is the big difference between the focus of green bonds when we published the original green bond principles, which is in 2014. It was really focused on projects. So what are the specific, essentially renewable energy farm or clean transport project or a new building with low energy efficiency, etc., that could essentially be tangibly kind of linked to the bond's use of proceeds. That's how that market started. But what this is about, as Barnabas said, was it's really about what the issuer is doing at a more senior level. That's what's of interest. So then the first thing that has to come is that intentionality, right? So the board, the senior executives have to have a long-term strategy in place, which is essentially a commitment on paper, and then put together a program of how they would achieve that with short, medium, and interim forward-looking targets on an ex-ante basis, hopefully disclosed to the market, which is then science-based, has to have some sort of talk or discussion around 1.5 degree trajectories. And I think what will be interesting is that we cannot just say, if you're not on the 1.5 degree trajectory, you're out of this, because in many industries, many countries, many markets, that first step is actually the big one that they have to make, which is, well, we're here today. How do we get onto a similar trajectory of decarbonization as required by the 1.5 degree pathway? So that's something to know. But then the final bit, which comes to your point, is that transition bonds should really be starting to think about more about corporate expenditures which facilitate and enable the issuer's long-term strategic plan. So it's not necessarily that they go, right, here's a windmill, we'll link the pay to that. It's the capital allocation on a medium basis, really, that investors are looking for, to say, the board of directors, senior management, you tell us that you're committed to climate change, you've published this glossy strategy, tell us how you are going to actually achieve that, and what kind of expenditures do you need that will enable that. That's what investors like me care about. That's the difference. So while I respect the green bond formula, I run the green bond analysis team at AXA IM, and we look at tens and tens of issuances every month. I think that when it comes to the issue of transitioning hard-to-abate sectors and whether that has value add and additionality, I hate to say this, but transition bonds could be very additional. This isn't just refinancing of existing assets. This would be forward-looking change of the corporate issuer's direction of travel away from business as usual to a net zero future. So actually, if you really think about it, this is very exciting.
Very much. Thank you very much, Yo. I think this was a very interesting session, and we're running out of time. So in conclusion, I think, from a climate change to inclusive growth, from green to brown, from sustainable loans to transition bonds, from labeled use of proceeds to sustainability or impact-linked financing, I think transition is inevitable. Financial institutions will need to provide the majority of the capital and enable this overall transition of the global economy with a required speed to keep us within the 2 degree centigrade warmer world. It was an extremely educative session for me personally, and I believe that the narratives, the guidelines, the labels, and the frameworks on transition finance, bonds, are much demystifying, thus providing a window of opportunity that needs to be tapped. I would like to thank all the panelists and the participants for joining in. But before we close, just a heads up, tomorrow we start with a very interesting discussion on how low carbon hydrogen will be a key part of the transition solution, followed by the big moves in transitioning the financial system, a launch by the JP Morgan Climate Bonds Index, and finally, at the end, on how do all parts of the transition puzzle fit in together. So log in to be a part of this very exciting journey, and thank you very much once again to everyone who was enthusiastically a part of the last 1 hour. Thank you.
Thank you very much.